I'm Matt Bouchard with REIT.com here in Atlanta for REITWorld 2014, NAREIT's annual convention for all things REIT. Joining me for this CEO Spotlight is Ed Walter, the President and CEO of Host Hotels and Resorts. Ed, thanks so much for joining us.
Good to be here, Matt.
Now I wanted to start by talking a little bit about the company's move to expand its global presence. What do you see as the ideal mix between domestic and international assets?
You know, we started to invest internationally, and by that I mean outside of North America, in 2006 when we acquired a portfolio of assets from Starwood in conjunction with a much larger transaction. And since that point in time, we've expanded into Brazil. We also have assets in Asia, in the Asia-Pacific region, both in Australia and in New Zealand. Today, if you looked at our international investments, they probably represent about 15% of the overall properties that we have some level of control over. But if you look at them in terms of their significance to our earnings, meaning our contribution to our EBITDA, they're slightly less than 10%. I would think going forward that as long as appropriate opportunities present themselves, I'd like to see that grow, but I don't think it grows significantly. I think it grows modestly. We're probably in that 10 to 12% range in the next couple of years.
And Host has a long-term track record of strong earnings growth. What are the keys to keeping up that growth trajectory?
You know, I think there's a number of them. The first really starts with how well do we and our operators operate our properties. And so our entire asset management department is focused on generating both revenue growth and expense savings so that you get NOI growth. And that's certainly the core that drives that earnings growth. On top of that, it's a function of how we invest. So whether we're investing in our assets or buying new assets, doing that in a way that's accretive to earnings as opposed to dilutive earnings is an important component. The last feature, and this has certainly benefited the entire REIT industry over the last 3 or 4 years, is how we manage our balance sheet. And by taking advantage of opportunities to refinance debt that we have at much lower rates, we've been able to accelerate our earnings growth.
And lastly, how is the likelihood of rising interest rates affecting your planning for next year?
You know, for our industry, it's a little bit different from others. You know, first I would say is that from a balance sheet perspective, about 80% of our debt is fixed rate, and none of the fixed rate debt comes due until 2019. So near-term consequences of higher rates are not significant for us. But I think what's probably more important for lodging and maybe more beneficial for lodging is assuming that the higher interest rates are driven by better economic activity. That bodes well for our business because that probably means more travel. That means, you know, better rates, better RevPAR, better profits.
Ed, thank you so much for joining us.
Great to be here.
For more on this and other REIT news and analysis, be sure to visit REIT.com.